Does the stock market feel like a casino where only the wealthy win? That's a common misconception. In reality, it has historically been one of the most effective wealth-building tools available to everyday people. I'm going to simplify the entire system into 5 steps so you can start learning how to build financial freedom today. If you're ready to stop relying only on your paycheck and start learning how to make money work for you, hit that subscribe button and turn on notifications. Let's simplify the market. Step 1. The silent thief. Why you should consider investing. Before we talk about how to invest, we need to talk about why keeping all your money in cash can be risky. Most people think a savings account protects their money. In reality, inflation reduces its purchasing power over time. Example, imagine you hid $100 under your mattress in 2005. By 2026, that same $100 buys significantly less, closer to $60 worth of goods compared to back then. Inflation gradually reduced its value. If your money isn't growing, it's losing ground. Banks may pay 0.5% to 4% interest, while inflation often averages around 3%. That means you're running up a down escalator just to stay in place. Historically, the stock market has outpaced inflation. The data. Over the last 30 years, the S&P 500 has returned an average of about 9 to 10% per year. The result? That's several points above inflation. You don't invest to get rich overnight. You invest to protect your money from losing value and to grow steadily over time. Step 2. What you are actually buying. Ownership versus tickers. The biggest mental block beginners have is thinking stocks are just electronic lottery tickets, symbols blinking on a screen. Delete that image. When you buy a stock, you are buying ownership. Think about your local pizza shop. If you buy a share of that shop, you're a partial owner. When they sell a pepperoni pizza, you get a tiny slice of the profit. When you buy Amazon, you own part of their delivery trucks, warehouses, and cloud servers. When you buy McDonald's, you own part of their real estate empire. This is the shift from consumer to owner. When you see a line of people waiting for the new iPhone, the consumer sees a cool gadget. The investor sees revenue flowing into Apple. The stock market is simply a marketplace where you can buy rights to the profits of some of the most innovative companies in the world. You don't have to build the next Tesla. You can own a piece of it. Step 3. The basket strategy. Risk management. But what if the company goes bankrupt? That's the #1 fear, and it's valid. Companies like Enron or Blockbuster went to zero. If you try to pick the next big thing, you're searching for a needle in a haystack. Even professionals struggle. The data. According to the SPIVA scorecard, over 15 years, nearly 90% of professional fund managers underperformed the market average. So how do you win? You buy the whole haystack. This is called an index fund, or ETF. Instead of buying one stock, you buy a basket of the 500 largest companies in America, the S&P 500. It includes Apple, Microsoft, Google, Walmart, Chevron, Visa, and more. The safety mechanism: if one company fails, it's removed and replaced by a stronger one. The result? You're betting on the entire American economy, not just one CEO. Historically, the S&P 500 has delivered positive returns over every 20-year rolling period. It's the ultimate build wealth steadily vehicle. If this basket strategy makes sense to you, please hit that like button. It helps us reach more future investors who are still on the sidelines. Step 4. The 8th wonder. Compound interest. Einstein reportedly called compound interest the 8th wonder of the world. This is the engine of wealth. Money earning money on its own money. Let's look at the math for a beginner. Invest $500 a month, about $16 a day. Year 1, you have about $6,300. Year 10, roughly $100,000. Year 30, over $1 million. Here's the breakdown. You invested $500 times 12 months times 30 years, which equals $180,000 of your own cash. But the account is worth $1 million. Where did the other $820,000 come from? It came from your money working for you over time. Think of it like planting a tree. At first, it's small and unimpressive, but year after year, it grows taller, stronger, and eventually provides shade, fruit, and value far beyond the original seed. That's compound interest in action. This is why starting early matters. The earlier you begin, the less you have to contribute to reach big goals. Step 5. The logistics. How to actually start. Okay, you're sold on the concept. How do you physically do it? It's easier than ordering an Uber. Step 1. Open a brokerage account. You need an app to buy stocks. Fidelity, Charles Schwab, and Vanguard are known, regulated, and low-cost options. Step 2. Choose the account type. Standard brokerage, withdraw anytime, but gains are taxable. Roth IRA, a powerful beginner option. You contribute up to $7,000 in 2025, $7,500 in 2026 if under age 50, and it grows tax-free. Withdrawals in retirement are tax-free if the rules are followed. Step 3. Buy the basket. Transfer money from your bank. Search for the ticker symbol of the S&P 500. VOO, Vanguard S&P 500 ETF. IVV, iShares Core S&P 500 ETF. SPY, SPDR S&P 500 ETF Trust. Click Buy. That's it. You've taken your first step towards becoming an investor. The goal is to automate this. Set up a recurring transfer every payday. Treat it like a bill you pay yourself. The stock market isn't magic, it's a system. Inflation reduces cash value. Stocks represent ownership in real businesses. Index funds spread risk. Compound interest multiplies growth. Roth IRAs protect gains from taxes. You don't need to be a genius, you just need to be consistent. Patience and discipline are the real secret weapons. The market rewards time in the game, not timing the game. I'm curious to hear from you. What is the one thing holding you back from investing right now? Fear? Confusion? If you are already investing, what was the first stock or fund you ever bought? Drop your answers in the comments and subscribe for more educational content on personal finance. Thanks for watching.